A stock buyback might sound complicated, but it's actually quite simple and a common strategy companies use to manage their finances and reward shareholders. Think of it like a company buying pieces of its own pizza from the market and putting them back in its box. This reduces the number of slices available to everyone else, which makes the remaining slices more valuable. Essentially, the company is saying, "We believe in ourselves, and we want to own more of our own business." Quote, "Understanding stock buybacks is important because it helps investors see how companies manage their shares, improve shareholder value, and signal confidence to the market."
Let's take a practical example. Suppose a company has 1 million shares outstanding, and you own 10,000 shares. That's 1% of the company. The company decides to buy back 200,000 shares from the market. After the buyback, only 800,000 shares remain. Your 10,000 shares now represent a larger ownership percentage, 1.25% instead of 1%. In other words, each remaining share becomes more valuable because the company is spreading the same profits over fewer shares. Buybacks also often signal that the company believes its stock is undervalued, which can encourage confidence among investors. Over time, this can lead to higher stock prices and potentially greater dividends. Stock buybacks provide several benefits for both companies and shareholders. First, by reducing the total number of shares, the company increases earnings per share, which can boost stock price. Second, it signals confidence. The company is effectively saying, "We believe in our growth and want to invest in ourselves." Third, for long-term investors, a buyback can lead to higher ownership percentage and greater share of future profits without additional investment. However, it's also important to understand the context. Companies may also buy back shares when they have excess cash and fewer profitable opportunities for growth. Overall, a stock buyback is like the company taking some slices of pizza off the table and giving more value to the remaining slices. Fewer shares, higher value, smarter ownership, a simple yet powerful tool in corporate finance.